Welcome to our deep dive into The Intelligent Investor.
Oh, yes.
Benjamin Graham's legendary guide to the world of investing.
Yeah.
We're taking this plunge because you're ready to level up your investing game.
Absolutely.
And this book, even decades later, offers a treasure trove of wisdom
It truly does.
about navigating the markets.
Graham's insights into market cycles
Yeah.
and investor psychology are just as relevant today as they were back then.
And that's what's so amazing about this book.
Yeah.
It's that it stood the test of time.
It has.
You know what I mean?
It really has.
He provides this framework for making sound investment decisions that can help you weather any storm.
Right.
I love that you mentioned psychology,
Mm-hmm.
because one of the first things that struck me was Graham's definition of an intelligent investor.
Yeah.
He doesn't picture some Wall Street hotshot, does he?
No, not at all. He really emphasizes temperament over sheer IQ.
Okay.
He argues that the intelligent investor is patient,
Mm-hmm.
disciplined, eager to learn, and crucially able to control their emotions and think for themselves.
Yeah.
In essence, it's about having the right mindset, a long-term perspective, rather than falling prey to the whims of the market.
So, you could be a math whiz,
Right.
but if you panic and dump your stocks at the first sign of a downturn,
Yeah,
that's not exactly intelligent investing.
exactly. Is it?
Not at all. And Graham is also very clear about the distinction between investing and speculating.
Yes.
To him, investing is about owning a piece of a business
Mm-hmm.
and participating in its long-term growth.
Right.
It's about understanding the fundamentals.
Yeah.
Speculating, on the other hand, is closer to gambling.
Yeah, you could say that.
Trying to time the market, chasing quick profits based on those short-term price swings.
fluctuations.
Yeah,
Yeah.
exactly.
Yeah.
And that brings us to one of Graham's most famous concepts,
Yes.
the margin of safety.
Mm-hmm.
I have to admit, when I first encountered this idea, it was a real aha moment for me. Can you unpack that for our listener?
Absolutely. The margin of safety is all about buying assets for significantly less than their intrinsic value.
Okay.
It's that cushion, that buffer that protects you.
Okay.
If your assessment of a business is off the mark,
Mm-hmm.
or if the market takes an unexpected turn.
So it's like a buffer just in case you're wrong?
Yeah, in case you're wrong or in case something unforeseen happens.
Got it.
Yeah.
Do you have a favorite example of Graham putting this principle into action?
Well, there's his analysis of Northern Pipeline Co.
Okay.
back in 1925.
Okay.
Graham discovered that the company's stock was trading for less than the value of the bonds it held.
What?
That's an extreme example,
Yeah.
but it perfectly illustrates the power of a substantial margin of safety.
So let me make sure I understand this.
Okay.
He could have bought the stock,
Uh,
turned around and sold off those bonds for more than he paid for the entire company,
Yes.
and still had the rest of the business.
that's the gist.
Yeah.
Yes.
Wow.
And that's the beauty of a wide margin of safety.
Okay.
It's about tilting the odds in your favor, minimizing downside risk while maximizing your potential upside.
Incredible.
Yeah.
Now, speaking of tilting the odds,
Yes.
we have to talk about Mr. Market.
Of course.
This is Graham's brilliant analogy for the stock market.
It is a good one.
And it really helped me understand how to think about market fluctuations.
It's a powerful analogy.
Isn't it?
He personifies the market as this manic, depressive fellow
Okay.
who's always offering to buy or sell your stocks at wildly fluctuating prices.
Right.
Some days he's euphoric, other days he's doom and gloom.
So it's like this emotional
Wow, it's-
coaster.
He goes up and down.
And the intelligent investor shouldn't get swept up in those mood swings, right?
Exactly. The key is not to let Mr. Market dictate your decisions.
Don't let him control you.
You use his rationality to your advantage.
So you're saying use his emotions against him.
In a way, yes.
Okay.
When he's overly pessimistic, offering to sell you valuable businesses at bargain prices you buy. When he's irrationally exuberant, driving prices through the roof,
Yeah.
you consider selling.
So in a way, you're profiting from the emotional overreactions of other investors.
You say that.
But being that calm and collected amidst all the noise,
Right.
that's got to be tougher than it sounds.
It is.
Yeah.
And not everyone can stomach those big market swings.
Yeah.
Remember, Graham was writing in the wake of the Great Depression
Mm-hmm.
and had seen firsthand the devastating consequences of market crashes.
Oh, yeah, absolutely.
That's why he distinguishes between different types of investors.
Okay.
He recognizes that not everyone has the same risk tolerance
Right.
or the same amount of time to devote to investing.
Totally makes sense.
Right.
Right? He talks about defensive and enterprising investors.
Uh-huh.
For our listener who's eager to get started but might be new to all this, how would you explain the difference?
Well, a defensive investor, what some might call a passive investor,
Right?
prioritizes stability and simplicity.
Oh.
They're looking for solid returns, but aren't necessarily interested in spending hours poring over financial statements or trying to pick individual stocks.
Yeah.
They want a portfolio they can set and forget, more or less.
They don't want to have to think about it all the time.
Yeah, they're not looking to be actively managing it.
Okay, so for someone just starting out,
Right.
this approach might be a good entry point,
It could be.
a way to build a solid foundation.
Think of it as the bedrock of your investing journey.
Okay, I like that.
Graham even suggests specific techniques for the defensive investor, like dollar cost averaging.
You mean investing a fixed amount regularly,
Exactly.
regardless of whether the market's up or down?
Yes, that's right.
It's a powerful technique, especially for those who might be prone to emotional decision-making.
Yes, it is.
By investing consistently, you buy more shares when prices are low and fewer when they're high, averaging out your cost over time.
You got it.
That makes a lot of sense.
That does.
But it also takes advantage of a behavioral quirk we all have, doesn't it? Mm-hmm.
We tend to get excited and buy more when things are going up and then panic and sell when things are falling.
It's human nature.
It is.
Dollar cost averaging forces you to do the opposite.
Right. It forces you to buy when everyone else is selling,
Exactly.
which is hard to do emotionally,
It is.
but it's the right thing to do.
It is. It imposes discipline and helps to remove emotion from the equation.
That's a good thing.
It is.
Now, for those who are a bit more hands-on,
Right.
who are ready to roll up their sleeves and dig deeper,
Yes.
Graham offers the path of the enterprising investor.
Right.
Ah, yes, the enterprising investor.
Uh-huh.
This sounds more like the classic image of stock picking, the quest to find those hidden gems in the market.
It does.
Let's own it.
It does. But even for these investors,
Okay.
Graham has some words of caution, especially when it comes to the allure of growth stocks.
Growth stocks.
Yes.
The promise of finding the next Apple or Tesla before everyone else catches on.
Right.
It's tempting.
It is very tempting.
And Graham acknowledges the potential for high returns with growth stocks,
Mm-hmm.
but he also emphasizes their inherent risks.
Right.
He wasn't afraid to call out the hype surrounding certain companies,
Even back then.
even back then.
Do you have any examples that might resonate with our listener?
Well, he uses Texas Instruments as a case study.
Okay.
It was the high-flying tech stock of its time,
Okay.
its price soaring meteorically.
Right up and to the right.
But then earnings faltered,
Uh-oh.
and the stock plummeted.
Oh, no.
It's a classic cautionary tale about the volatility that often comes with growth investing.
Yeah, I see that.
And we've seen this story play out time and again,
Oh, absolutely.
haven't we?
Like in the dot-com bubble.
The dot-com bubble is a perfect example.
Or even the more recent boom and bust cycles in certain tech sectors.
Exactly. History tends to repeat itself.
It really does.
Yeah.
So even if you're an enterprising investor,
Right?
you need to approach growth stocks with a healthy dose of skepticism.
A healthy dose of skepticism and a good understanding of the underlying business.
Yeah.
And Graham's insights remain as relevant today as ever, especially in a market that's constantly bombarded with new speculation and hype.
It's hard to cut through all the noise.
It can be.
This is incredibly insightful.
I'm glad you're finding it helpful.
I'm starting to see the world of investing in a whole new light.
That's great to hear.
But I know we've only just scratched the surface of what Graham has to offer.
We have?
Where do we go from here?
Well, let's delve into some of the specific traps.
Okay.
Graham highlights for enterprising investors those pitfalls they need to be aware of.
Mm-hmm.
We'll also explore his advice on portfolio construction,
Yes.
that age-old question of how to allocate your assets between stocks and bonds.
That's a big one.
It is a big one.
I want to learn more about that.
There's a lot to unpack, so let's dive in.
Let's do it. Okay, so we've established that even enterprising investors need to tread carefully,
Right.
especially with those alluring growth stocks.
They can be very tempting.
They can be. Yeah. But let's talk portfolio construction.
Okay.
This is one of those fundamental questions for any investor, isn't it?
It is.
How do you decide how much to put into stocks versus bonds?
Right.
What's the right mix?
That's the million-dollar question.
It is.
Well, for the defensive investor,
Okay.
the one seeking stability and simplicity,
Right.
he recommends a minimum of 25% in bonds
Okay.
and a maximum of 75% in stocks.
So even for someone who's more risk averse,
Uh-huh.
who might be tempted to play it super safe,
Yeah.
Graham wouldn't advise shying away from stocks completely.
Not completely, no.
Okay.
But it's important to remember that Graham was writing in a different era,
Yeah.
back when interest rates were significantly higher.
Oh, that's right.
Yeah,
That means those bonds would have generated a pretty decent return on their own right.
they would have.
A nice, steady income stream.
Exactly. A nice steady income stream. And they would have acted as a ballast for the portfolio when stocks inevitably went through their turbulent periods.
So they would have kind of balanced things out.
Exactly. They would have provided that stability.
Okay.
Yeah.
Today, with interest rates much lower,
Right.
bonds don't offer the same level of income or protection.
That's true.
So how should we, as modern investors, adjust our thinking?
That's a good question.
Should we still stick to Graham's 25-75 split?
Well, that's where things get a bit more nuanced.
Okay.
You might want to consider a larger allocation to stocks,
Okay.
especially if you have a longer time horizon.
Okay.
And by that, I mean you don't need to access this money in the near future.
Right.
You have time to ride out the market's inevitable ups and downs.
So the younger you are,
Uh,
the more time you have to recover from potential losses,
right.
the more heavily you might lean towards stocks.
That's a reasonable way to think about it.
Okay.
But even if you adjust the percentages,
Okay.
the underlying principle remains the same.
Which is
Diversification.
right. Don't put all your eggs in one basket.
Exactly. Spread that risk around.
Don't get too concentrated in any one asset or sector.
Right. And within that bond portion of your portfolio,
Okay.
think about what Graham emphasized,
Mhm.
safety and reasonable returns.
Okay.
He even suggested certain types of bonds, like U.S. savings bonds,
Oh, yeah.
which were quite popular in his day.
Those were offering much higher interest rates back then, weren't they?
There were. Times have certainly changed.
They have.
Yeah. But the core principle of seeking a stable foundation within your portfolio still holds true.
Okay.
Now let's turn to the enterprising investor.
Okay.
They're the ones who are ready to do the research, to put in the effort to find those undervalued opportunities.
The stock pickers.
The stock pickers, yes.
How should they be thinking about structuring their portfolio?
Well, it seems like they'd have a bit more flexibility, wouldn't they?
They would, given their willingness to take on more risk.
Graham suggests they could be more flexible, yes,
Okay.
but he still emphasizes the importance of that margin of safety.
Always that margin of safety.
He even suggests looking for bargains among larger, well-established companies,
Okay.
those that might be temporarily out of favor with the market.
The ones that have solid fundamentals,
Yes.
but maybe their stock price has taken a dip for some reason.
Precisely. Those are the situations where you can often find hidden value.
Ah, I see.
But Graham cautions against chasing cheapness for its own sake.
There's got to be more to it than just a low price tag, right?
There is. It all comes down to understanding the underlying business.
Okay, so you got to look under the hood.
You got to look under the hood. Yeah, what's its competitive position?
Yeah, okay.
How strong are its financials?
Hmm.
Is it generating consistent earnings?
So it's not just about looking at the stock price in isolation,
Right.
but at the business itself, its ability to generate profits over time.
Exactly. That's where true security analysis comes in.
And that can get pretty complex, can it?
It can be.
Especially for someone who's not a professional analyst.
It can be intimidating for sure.
It's easy to get overwhelmed by all the data and jargon.
That's why Graham provides some key things for the average investor to focus on.
Okay, what are those?
He talks about looking at a company's long-term earnings record,
Okay.
its financial strength and capital structure,
Mm-hmm.
its dividend history if it pays one.
Okay.
So it's about looking at the whole picture.
So even though his specific examples might be outdated,
Right.
the process of analysis he lays out,
Mm-hmm.
the way he teaches you to think like an owner, not just a trader,
Right.
that's still incredibly valuable, wouldn't you say?
Absolutely. He's equipping you with a framework for making informed decisions, for cutting through the noise,
Yeah.
and focusing on what truly matters.
And that's what separates the intelligent investor
Yes.
from the speculator.
From the speculator.
The one who's chasing hot tips and following the herd.
Right. They're just reacting emotionally.
This is all making so much sense.
I'm glad to hear that.
But I have to admit, I'm still a bit intimidated by the idea of actually picking individual stocks.
I understand.
Is there an alternative for someone who might not have the time or expertise to do all that deep analysis?
There is.
What about those of us who aren't ready to become full-blown enterprising investors?
Well, Graham recognized this.
Okay.
He talked about the role of investment funds,
Okay.
what we now call mutual funds,
Right.
as a way for the average investor to access professional management and diversification.
So instead of trying to pick winning stocks yourself, you're essentially entrusting that to someone else.
That's right. But Graham also had some reservations about mutual funds.
Even back then?
Even back then, he was wary of high fees,
Okay.
which can eat into your returns,
Yeah.
and of overly aggressive strategies,
Right.
which can lead to excessive risk-taking.
Which sounds familiar.
It does.
There are definitely a lot of mutual funds out there that don't seem to be serving their investors very well.
That's true.
How can investors choose wisely?
Well, it all comes down to doing your homework.
Okay.
Just as you would with individual stocks,
Mhm.
look for funds with low fees,
Okay.
a solid long-term track record,
Mhm.
and most importantly, a manager who aligns with your investment philosophy.
Okay.
Someone who understands and applies Graham's principles.
Someone who's read The Intelligent Investor.
Exactly, someone who's on the same page.
Got it. But choosing the right investments is only part of the equation.
Right.
Graham also reminds us that we are often our own worst enemies when it comes to investing.
Oh, that's so true.
What did he mean by that?
He was referring to the role of psychology in investing,
Okay.
how our emotions can lead us to make irrational decisions, especially when the market gets turbulent.
Like when we panic and sell at the bottom.
Exactly. Think about it when prices are soaring.
Mm-hmm.
We get greedy. We chase returns. We convince ourselves this time is different.
Right.
And then when the market inevitably corrects,
Yeah.
we panic and sell at the worst possible time, locking in losses.
It's like we're constantly fighting against our own instincts.
It's exactly.
Graham understood that human beings aren't always rational actors, especially when money is involved.
Yeah, money can make people do crazy things.
It can.
So that's why having a sound investment philosophy,
Right.
like the one he outlines in The Intelligent Investor,
Yes.
is so crucial.
It is crucial. It provides you with a framework for making decisions based on logic and reason, not fear and greed.
It's like having that inner voice of reason,
Yes.
that calm amidst the storm, reminding you to stick to your plan, even when everyone around you is losing their heads.
That's a great way to put it. It's about having the discipline to stay the course even when it's uncomfortable.
Yeah, you have to be able to stomach the ups and downs.
You do.
And that, in essence, is what it means to be an intelligent investor.
Absolutely. It's about having the right mindset, the right approach.
All this talk about discipline makes me think about those specific strategies for enterprising investors,
Okay.
the ones who are ready to take a more active role in managing their portfolios.
What are some of the techniques Graham recommends for finding those elusive bargain issues?
That's a great segue. Graham does outline several strategies for the enterprising investor,
Okay.
approaches that require more digging, more analysis, more of that detective work we talked about earlier.
This sounds interesting.
Let's dive into those next.
So we've covered a lot of ground, from understanding the mindset of an intelligent investor to the importance of diversification and the eternal battle against our own emotions. But now let's get into the nitty-gritty. What are some specific strategies Graham outlines for enterprising investors, the ones who are ready to dig deep and uncover those hidden gems in the market?
Well, one strategy that Graham highlights is arbitrage. Now, that might sound intimidating, but the basic idea is actually quite simple. It's about exploiting price discrepancies between different securities.
Okay.
Imagine a company that has two classes of stock, let's say Class A and Class B, where both classes have similar rights. But for some reason, Class B is trading at a significant discount to Class A.
So as an enterprising investor, you could swoop in, buy up that cheaper Class B stock, wait for the market to recognize the discrepancy, and then pocket a tidy profit when the prices converge.
That's the essence of arbitrage. Graham saw these situations as opportunities to earn a decent return with relatively low risk. Of course, it requires careful analysis. You need to understand why that price difference exists in the first place and be reasonably confident that it's likely to close. But for the astute investor, these situations can be a way to capitalize on market inefficiencies.
It's like being a detective, isn't it? Searching for those clues that everyone else has overlooked. What other strategies does Graham recommend for those willing to put in the detective work?
He talked about liquidations, which occur when a company is being dissolved and its assets are sold off. Now, for the enterprising investor, this can present a unique opportunity.
Because you could potentially buy those assets for less than their true worth, knowing that they'll eventually be sold off at a higher price.
Exactly. But this approach requires careful scrutiny of the company's balance sheet. You need to understand its liabilities, estimate the potential proceeds from the sale of its assets, and make sure you're not overpaying. It's not for the faint of heart, as it can be quite complex.
Definitely not a passive strategy. Then, okay, what about related hedges? That's another term Graham uses that might need some explaining.
A related hedge is a situation where a company owns a significant stake in another company, and that stake is actually worth more than the market price of the parent company.
So you're essentially getting the subsidiary's value for free, plus whatever the parent company's other businesses are worth.
That's a simplified way to think about it, yes. But once again, it requires thorough analysis. You need to assess the subsidiary's financials, understand its business model, and determine whether the market is truly undervaluing its potential. It's about peeling back those layers, looking beyond the surface, and finding those hidden pockets of value.
It all sounds like a fascinating intellectual challenge. Are there any other strategies Graham recommends for the enterprising investor?
There's one more we should definitely discuss, net nets. This is a classic Graham technique, and it's all about finding companies whose stock is trading for less than the value of their net current assets.
For those of us who need a refresher, what exactly are net current assets?
It's the company's current assets, things like cash accounts, receivable inventory, the stuff they can easily turn into cash minus their total liabilities. So essentially, you're buying a company for less than the value of its most liquid assets with all of its other assets thrown in for free.
That sounds like an incredible deal. Almost too good to be true.
It can be, and Graham found that net nets tended to outperform the market over time. But it's important to note that finding true net nets in today's market is much rarer than it was in Graham's day. Information travels faster, markets are more efficient, and those obvious bargains tend to disappear quickly.
So the hunt for those net nets is even more challenging now, but the potential rewards could still be significant.
That's right. But even if you stumble upon a potential net, you can't just blindly buy it. Due diligence is still essential. You need to make sure the business is viable, that its assets are truly worth what they seem, and that management is trustworthy. It all circles back to Graham's core principle, that margin of safety.
It's about protecting yourself on the downside, knowing that even the most thorough analysis can be wrong.
Precisely. Graham's entire approach to investing revolves around finding those situations where the odds are in your favor, where you're not just speculating but investing with a cushion of safety. That's how you minimize risk and maximize your chances of success over the long term.
Wow, this has been an incredible journey through The Intelligent Investor. We've covered so much ground, from understanding Graham's definition of an intelligent investor to exploring specific strategies for both defensive and enterprising approaches. As we wrap up this deep dive, what stands out to you as the most important takeaway for our listener?
I think Graham's emphasis on temperament is absolutely crucial. It's not about being the smartest person in the room or having access to the most sophisticated algorithms. It's about having the patience, the discipline, and the emotional control to make rational decisions even when the market is throwing a tantrum.
It's about being the eye of the hurricane that calm amidst the storm. It's about not letting Mr. Market get inside your head and dictate your actions.
Exactly. And remember, the intelligent investor isn't about get-rich-quick schemes or trying to time the market. It's about building wealth slowly and steadily over time with a focus on value and a commitment to owning great businesses.
It's about being an owner, not a gambler, about thinking long-term, not short-term. And if our listener can embrace that mindset, they'll be well on their way to achieving their financial goals.
I couldn't agree more.
This deep dive has given me so much to think about, and I'm inspired to go back and reread The Intelligent Investor with fresh eyes. Any final words of wisdom for our listener as they embark on their own investing journey?
Just this, remember Graham's core principle, the margin of safety. Seek out undervalued opportunities, be patient, and let time work its magic. And above all, don't let Mr. Market get inside your head. Stick to your plan. Stay disciplined, and you'll be well on your way to becoming an intelligent investor.
Beautifully said. Thanks for joining us on this depth dive into The Intelligent Investor. Until next time, keep learning, keep exploring, and keep investing intelligently.